All right, so till now we have done question which were related to the consolidated statement of financial position. Now we are doing a question which does have the income statement as well. So it's the question number 369 Premiur from your latest Kaplan kit. And let's just solve it. On 1st June 20x0, Premiur acquired 80% of the share capital of the Sanford. So now the working one is given and there is no need to calculate that 80%. So the group structure is that the parent has acquired 80% shares. The consideration consisted of two elements: a share exchange of 3 shares in Premiur for every 5 acquired shares in Sanford. So now in order to calculate this, you have to see the statement of financial position. So first of all, $1 and then 5,000. So the total number of shares are 5,000 and the parent has acquired 80% share. That gives the number of shares that has been acquired. Now the fraction. So the fraction is share exchange of 3 shares for 5 shares. So 3 by 5. And now you need the share price. So the share price is actually $5. When you multiply it by 5, it gives you the complete consideration. Now let's just work out. Okay, 5,000 into 0.8 into 3 divide by 5 into 5. So it gives you 12,000. And if you split it between the share capital and share premium, so it will be 5,000 into 0.8 into 3 divided by 5 into 1. It's 2,400 and the remainder will be 9,600. So the entry will be debit cost of investment, credit share capital, and credit share premium. So 12,000, 2,400, and the rest will be sorry, share premium. In Sanford, an 8 lakh cash. The share issue has not been recorded by the Premiur. That means this investment, which is 1,800, does only have 1,800 minus 800 cash. Other than that is the investment which is other than the subsidiary, because this is 1,800 and only 1,800. This is 1,800 contains only the cash, and the rest is the investment which is other than the subsidiary. The share issue has not yet been recorded by Premiur. At the date of acquisition, the shares in the Premiur had a market value of $5. Okay, we have taken that. And now we have the income statement. So I said whenever you're preparing the income statement, so you have to see the mid-year acquisition. So the year net is 30th September and the subsidiary is acquired on 1st June. June, July, August, September. So remember one thing, that you will write 4 by 12 over here because you cannot consolidate for the full subsidiary. You will be taking only 4 months. Okay, next. So there's one more thing. Let's go to the equity section. And the date of acquisition was, the date of acquisition was 1st June 20x0. Now we need the retained earning at acquisition as well. Do we have that? Do we have that? No, we have the retained earnings at reporting date, which is at 30th September, which is 4,500. That means you need to work out for the retained earning at acquisition as well. So at reporting date, it's 4,500. So we need the retained earning at acquisition. We need that at acquisition. This needs to be found out. Okay. So I already told you how to work it out. Okay, you have the retained earning at reporting date. Now you have the sorry. You have this full year profit, which is 3,900. Profit for the year, 3,900. So what we're going to do, this is at 30 September and we need 4 months back. So what we'll be doing, 3,900 into 4 divided by 12. So we need the profit for the 4 months. So 3900 into 4 divide by 12, it gives you the 1300. So now what we can do is we'll go there, 4500 minus 1300, because we have to go 4 months back, and 4500 minus 1300 gives you the 3200. So the retained earning at acquisition will be 3200. This is the point you need to know. We have calculated it. Okay, so 3200. Okay, now we have the notes. At the date of acquisition, the fair value of the Sanford's asset were equal to their carrying amount, with the exception of its property. This had a fair value of 1.2 million below its carrying amount. Sorry for my throat problem, okay, and had a remaining useful life of 8 years at the date of acquisition. So, okay, so you have the carrying value below, so, but you need to calculate the depreciation over here. So it's 1200 divide by 8, and we need the depreciation for only 4 months. So what it will be 1200 divide by 8 multiply by 4 divide by 12. It gives you 50. So 50 is the depreciation which should be added back because it is the downward revaluation. And I've explained this point as well. Sales from Sanford to Premiur throughout the year for the year ended 30 September 2020 had consistently been 1 million per month. Quite easy. So it's 1 million per month, okay? What we'll be doing, 1000 into 4, it gives you 4000. So this 4000 will be reversed from sales, debit sales, and will be reversed from the cost of sale as well. So this is the intra-group sale and cost of sale. Sanford made a markup on cost of 25% on these supplies. Premiur had 2 million of the inventory that had been supplied in the post-acquisition period as at 30 September 2020. Okay, so now we need to calculate the unrealized profit. Okay, Premiur had 2 million of inventory that had been supplied. Okay, so 2000 is actually the selling price, which represents 125%. And when we multiply it by 25%, this gives you the unrealized profit because the markup is 25%. So 2000 divide by 125 multiply by 25, it gives you 400. So 400 is the unrealized profit. So this is from Sanford to Premiur. That means it will be deducted from working number 2. Premiur had a trade payable balance owing to Sanford of 3,50,000 as at 30 September. This did not agree with the corresponding receivable books due to 1,30,000 payment. Okay, fine. This does not agree with the corresponding receivable due to 1,30,000, which Sanford has not yet recorded. Okay, this is the cash in transit. So cash in transit is debit cash, credit receivables, 130. And once it is balanced, then it will be debit payable, credit receivable, the intra-group contra entry will be 350. Premiur investment, including shares, which had the date of acquisition, were classified through fair value through other comprehensive income. The investment have increased in value by 300. So it's the gain of the parent, and it has increased by 300. The other equity reserve relates to these investments. It is based on their value. There were no acquisition or disposal. So if you remember, I have already told you that. So this 1800 contains 800 investment in subsidiary. The rest is the 1000, and we will be adding 300 into it, which is the gain of the parent, and it will be now 1300. So this will be the investment which we'll be consolidating. Okay, now we have read 4 points. Okay, the next point is Premiur policy is to value the non-controlling interest at the fair value and it is deemed to be 3.5 million, it is calculated. So 3,500. There has been no impairment. Fine. So now we have read all the question. Now we'll be going on our Excel sheet. So first of all, we will be having the consolidated revenue. Okay, the revenue is 92,500. Okay, so 92,500, and we have plus, but obviously we'll be applying the brackets because the subsidiary has 45,000 into 4 divide by 12, and then you have the intra-group sales, which is 4,000. So it is 103,500. Then you have the cost of sales. So cost of sale is, the parent one, 70,500. Okay, so it's 70,500 and plus the brackets, the subsidiary one, which is 36,000, obviously into 4 divide by 12. Fine. Then you have brackets close. Okay, then you have the intra-group cost of sales. Now then you have the unrealized profit, which was 400. Yes. And then you have the depreciation. Normally it is allocated, but here it was the downward, so minus 50. So it will be 78850. So what will be the gross profit? Okay, the gross profit will be sales minus cost of sales. Okay, fine. And then you have the other expenses. Okay, its other expenses will be 12,000 plus, you need to open the brackets, 5,100 into months by 12, 4 divided by 12, and that's fine, is 13,700. So the profit for the year will be gross profit minus this, it gives you 10950. Okay. So then you have the other comprehensive income. Okay, in the other comprehensive income, there was a gain of the parent, if you remember. Okay, yes, there was a gain in the working number 4. We'll be recording that. Okay, gain on investment. It is 300. So now you have the total comprehensive income. Okay, this is this plus this, 11,250. Now we are done with the income statement, and now you need to, first of all, have to split it. For the NCI, will be going over here. Okay, so what is the profit attributable to NCI? What was the total profit of the subsidiary? It was 3,900. So 3,900, but obviously we'll be taking only 4 months. So 4 divide by 12, and we will be multiplying it by the NCI percentage. And the percentage of the NCI was 20%. So 0.2. This is the profit attributable to NCI. Now we have the adjustments. Adjustments were the unrealized profit. Okay, so 400. And obviously we'll be deducting that. So we should have the minus sign. So 400 into 0.2. Minus 80, then you have the depreciation, but it will be added because it was the downward. So 50 into 0.2, it gives you 10. So It is 190. So we have calculated it 190 from the working. Now the remaining will be of the parent. So what will be that? And the equity of the parent is this one minus this one. So equity holders of the parent. Okay, fine. Similarly, total comprehensive income. Okay, the total comprehensive income is exactly the same. So it will be 11 to 50. And the NCA does not have any share of the gain because it was of parent. So 11 to 50. So this is how we have prepared our consolidated statement of profit or loss. Now we'll be going to the consolidated statement of financial position. Okay, first of all, the workings. The working group structure 80%, fine. Now we are just putting share capital of the subsidiary. Next page, share capital of the subsidiary. It was 5,000. Okay, 5,000. It will be same 5,000. Retained earning at acquisition. We have calculated that. It was 3,200. Retained earning at reporting date. It was 4,500. Okay, fair value adjustment. Yes, fair value adjustment, but the downward minus 1,200. Minus 1,200. Fine. Fair value depreciation 50. That will be added back. Unrealized profit is 400 minus. Okay. No other adjustments, right? So just total it 7,000. 7950, and the difference is this minus this. Okay, 950. Then you have the consideration. Okay, share exchange, we have calculated that. What was the value? Share exchange value was 12,000. And instead of loan note, we were having the cash. It was 800. Okay, no deferred consideration, no contingent consideration. What was the NCI? The NCI value was on the last page, it was 3,500. Net assets at acquisition is minus 7,000. Okay, so the goodwill on acquisition will be, and there is no impairment, so it will be 9,300. Okay, 9,300 exactly. Then you have the non-controlling interest at acquisition. It was 3,500. The share of the post-acquisition profit was 950 into 20%. It gives you 190, and the value will be 3,690. Retained earnings. Okay, retained earnings of the parent. First of all, we'll be taking that. It is 12,300, 12,300. And now the post acquisition, it was 950. Yes, 950 into 0.8. 760, we do not have any impairment, we do not have any unwinding, no acquisition cost, no other gains or losses, and it will be. Remember one thing, the gain was for other comprehensive income, so we cannot add that into retained earnings. We will be adding that over here in the other components of equity. Okay, now you have the property, plant, and equipment balance. Now let's just go to here. So 25,500 plus 13,900, okay, and minus 1,200 plus 50. Goodwill, it was 9,300. Investments, it was 1300. We have calculated that. Okay, then you have the current assets. The total is given, current asset. So we need to total. Okay, 12,500 plus, okay, 12,500. Yes, where is that? Yes, these two figures. 12,500 plus 2,400. And first of all, you will be adjusting the cash in transit. Okay, debit cash. What was the amount? Let's just see the amounts. 130. 130 will be added in the cash, deducted from the receivables. Okay. Deducted from the receivables. Then 400 is also deducted, which was unrealized profit. Then intragroup receivables, what was that? 350. So we'll be doing all adjustments in the total current assets. So it will be 14, just write it over here, 14150. Okay, fine. That gives you, okay, then you have the equity shares of the parent. It was 12,000 plus 2,400. Then you have the share premium, which will be 9,600. Then you have the retained earnings. What is that? 13060. 13060. Okay, then you have the other reserves. Yes, other reserves were 500. Okay, and in this 500, the gain will be added. 500 plus that gain 300. That belongs to the parents. Now 800. NCI, it is 3690. Okay, then you have the loans. Okay, we do not have any non-current liability, leave it. Good. In the current liability, it's 15,000 plus 6,800 and minus intragroup payable, which was 350. Yes. Now we are done. Let's just total it. Hopefully we have done it. 63,000. 63,000. Yes, balanced. Okay, this was the question. Premiur.